Imagine you swipe a card for $50 of groceries. No cash leaves your wallet. No money leaves your bank account. Instead, the bank pays the store, and now the bank is waiting for you to pay it back. That single mechanic, someone else paying on your behalf, temporarily, is the entire foundation of how credit cards work. Everything else, the rewards, the interest, the credit score, the debt traps, all grows out of that one simple idea. In this video, you'll learn 80% of how credit cards actually work in under 20 minutes using simple, practical examples. Understand what a credit card actually is. Imagine a friend says, "Buy it now, pay me back by the end of the month. No extra charge." That's essentially what a credit card issuer offers you. The bank fronts the money to the merchant instantly, and you owe the bank, not the store. If you pay the full amount back before the due date, the loan effectively costs you nothing. If you don't, the arrangement changes completely, and that's where most of the confusion and most of the cost begins. Follow the money on every purchase. Suppose you buy a $200 jacket with your credit card. The store gets paid almost immediately, minus a small processing fee it pays to the card network. Your card issuer now shows a $200 balance on your account. That $200 isn't a fee or a charge yet. It's simply what you owe. What happens next, whether you pay it off or let it sit, determines whether this purchase costs you $200 or considerably more. Understand the grace period. Imagine your statement closes on the 1st of the month, listing everything you charged during that cycle. You then have until the 25th, roughly a 24-day grace period, to pay that balance in full without paying any interest. If you pay it entirely by that date, every purchase in that cycle effectively became an interest-free short-term loan. Miss that date, even by paying most but not all of it, and the grace period typically disappears, not just on the unpaid part, but often on new purchases too.
See what carrying a balance really costs. Suppose you have a $2,000 balance and your card charges 24% annual interest. If you only make the minimum payment, maybe $50 a month, the interest keeps accumulating faster than your payments reduce the balance. At that rate, paying only the minimum could take years to clear $2,000 and could cost over $1,000 in interest alone, on top of what you originally spent. This is why credit cards can be either completely free or extremely expensive, depending entirely on one decision: paying in full or not. Understand minimum payments. Imagine your statement shows a $2,000 balance, but the minimum payment listed is only $40. That number is calculated to keep the account current, not to help you get out of debt efficiently. Paying only the minimum keeps you technically compliant, while the bank continues collecting interest on almost the entire remaining balance. The minimum payment protects your credit standing in the short term. It does very little to protect your wallet. Know your credit limit and utilization. Suppose your card has a $5,000 limit and you're carrying a $4,000 balance. You're using 80% of your available credit, a level that can quietly hurt your credit score, even if you make every payment on time. Now, imagine you pay that balance down to $500, a 10% utilization. Same card, same limit, but a much healthier signal to lenders. Utilization isn't just about avoiding debt. It's a number that follows you into every future loan application. Understand how your credit score reacts. Imagine two people both have credit cards. One pays in full every month and keeps utilization low. The other frequently maxes out cards and occasionally pays late. Payment history and utilization are two of the largest factors in a credit score. So over time, the first person's score climbs, while the second person stalls or falls. A credit card can be one of the fastest ways to build credit history, or one of the fastest ways to damage it. The card itself doesn't decide which, your usage does. Separate rewards from real value. Suppose a card offers 2% cashback, and you spend $2,000 a month on it, then pay it off in full every time. That's roughly $480 a year in rewards, essentially free money for spending you'd do anyway.
Now, imagine that same person occasionally carries a $1,000 balance at 24% interest. That single month can cost more in interest than an entire year of rewards earned. Rewards only add value when the balance is paid in full. Otherwise, interest charges erase them many times over. Understand annual fees. Imagine a card charges a $95 annual fee, but offers travel perks and rewards. If you use those benefits enough that they're worth more than $95, the card is a net positive. If you rarely use the perks, that $95 becomes a pure cost with nothing to show for it. Before paying an annual fee, calculate honestly what you'll actually use, not what sounds appealing on the card's marketing page. Know the difference between purchases, balance transfers, and cash advances. Suppose you use your card for a normal $300 purchase. This typically enjoys the grace period rules already covered. Now suppose you take a $300 cash advance from an ATM using that same card. Cash advances usually start accruing interest immediately, often at a higher rate, with no grace period at all, plus an upfront fee. The same piece of plastic can behave completely differently depending on how you use it, and cash advances are almost always the most expensive way to access money from a credit card. Understand introductory 0% APR offers. Imagine a card offers 0% interest on purchases for 15 months. During that window, a $3,000 purchase can be paid off gradually with no interest cost at all, effectively an interest-free loan. But suppose the promotional period ends and $800 of that balance remains. The interest rate can jump to the card's standard rate, sometimes 20% or more, applied to the remaining balance going forward. These offers are valuable financial tools when you have a payoff plan, and risky when the end date arrives before you're ready.
Watch how missed payments compound. Suppose you miss a payment due date by a few days. A late fee is added, your grace period may disappear, and if you're late by 30 days or more, it's typically reported to credit bureaus, affecting your score. Now imagine this happens repeatedly. Some cards apply a penalty APR, raising your interest rate significantly, sometimes on your entire balance. What starts as a small missed payment can cascade into higher costs and a damaged credit history that takes months or years to repair. Understand statement balance versus current balance. Imagine your statement closed showing $1,000 owed, but you've since made another $200 in purchases this new cycle. Your current balance might show $1,200, but paying the $1,000 statement balance in full by the due date still avoids interest. The $200 in new purchases falls under the next cycle's grace period, assuming you keep paying in full. Confusing these two numbers is one of the most common reasons people accidentally pay interest they didn't expect.
Price the cost of just this once. Suppose you normally pay your card in full, but one month you decide to carry a $500 balance just this once because cash is tight. At 22% interest, that decision costs roughly $9 that month if paid off quickly, or considerably more if it lingers. It feels small in isolation, but these just this once moments, repeated across months and cards, are often how manageable debt quietly becomes unmanageable. Before carrying any balance, calculate the real cost, not just the convenience. Use your card as a tool, not a spending increase. Imagine someone gets a credit card, and because the limit feels like available money, their spending creeps up by $300 a month compared to when they used debit. A year later, they're not necessarily in debt, but they've spent $3,600 more than they otherwise would have, with nothing extra to show for it. A credit card doesn't increase your income or your budget. Treating its limit as spending power rather than a payment method is one of the most common ways people quietly overspend. Build the habit that makes cards work for you. Suppose you set up autopay for the full statement balance every month and treat your credit limit the same way you treat your checking account, never spending more than you'd be comfortable paying in cash. Under this habit, the card becomes a tool for building credit, earning rewards, and adding purchase protection, all at zero cost. This single habit, paying in full every time, is the dividing line between a credit card being one of the most useful financial tools available or one of the most expensive mistakes. Manage your card as part of your whole financial system. Imagine two people, each have a credit card with a $5,000 limit. The first treats it as extra spending money, carries a balance, and rarely checks their statement. The second uses it for planned spending, pays in full every month, and tracks how it affects their credit utilization and score. Both have identical cards, but their financial outcomes are completely different. A credit card isn't good or bad on its own. It's a mechanism that amplifies whatever financial habits you already have. Understand how it moves money, when it charges you, and how it reports your behavior, and it becomes one of the simplest tools to use well. If you found this video helpful, then like, share, and subscribe to this channel to get future videos. Thank you for watching this.